One of the largest oil reserves ever controlled by a French company is sitting in Venezuela's Orinoco Belt in 1996, and the contract looks bulletproof. Total secures a 30.32% stake in Petrocedeño, a heavy oil project with decades of production ahead and geology that works as long as prices stay high and the operating environment stays stable. The first condition holds, the second doesn't. By 2004, Hugo Chávez begins renegotiating every foreign oil contract in the country, demanding majority control for the state and forcing companies to accept minority stakes in their own projects. The choice is simple: accept the new terms, or lose everything to expropriation and spend the next decade in arbitration courts trying to recover a fraction of what was taken. The contract is signed in Caracas in 1996, and the reserves are larger than anything Total has ever controlled. Petrocedeño, a heavy oil project in Venezuela's Orinoco Belt, represents one of the most significant upstream investments in Total's portfolio. The French energy company secures a 30.32% stake in the joint venture, partnering with Petróleos de Venezuela, S.A., the state oil company known as PDVSA, and Statoil of Norway. The geology is proven, the reserves are massive, and the production profile is long-term and predictable. In the late 1990s, Venezuela is open to foreign investment in its oil sector. The government of Rafael Caldera encourages international oil companies to develop heavy oil resources that require advanced technology and significant capital. Total's participation in Petrocedeño is part of a broader wave of upstream projects designed to boost production and attract foreign expertise. The project begins producing in 2001, and the output is upgraded into synthetic crude for export. The economics work. As long as oil prices remain above a certain threshold and the operating environment remains stable. For a time, both conditions hold. But the operating environment in Venezuela is not static. It is shaped by political forces that do not answer to shareholders or contracts. Venezuela in the early 2000s is undergoing a political transformation that will reshape its relationship with foreign oil companies. Hugo Chávez, elected president in 1998, consolidates power through constitutional reform, nationalization policies, and direct control over PDVSA. His government views oil as a tool of national sovereignty and social policy, not merely as an economic asset to be managed for efficiency. Chávez's approach to the oil sector is shaped by two priorities: maximizing state revenue and reducing dependence on foreign capital. In 2001, the government passes a new hydrocarbons law that increases royalty rates and asserts greater state control over joint ventures. The law signals a shift in the rules, but it does not immediately trigger a crisis. International oil companies, including Total, adapt to the new terms and continue operating. The Orinoco Belt, where Petrocedeño is located, contains some of the world's largest petroleum deposits. The oil is heavy, with high viscosity and sulfur content, and it requires upgrading before it can be refined into marketable products. The upgrading process is capital-intensive and requires specialized facilities, which Total and its partners built as part of the original investment. The economics depend on high oil prices and stable operations, both of which are vulnerable to political decisions made in Caracas. Total's strategy in Latin America during this period is anchored by Venezuela. The company has limited exposure elsewhere in the region, and its Venezuelan assets represent a significant portion of its upstream reserves and production. The decision to invest in Petrocedeño was made in the 1990s, when Venezuela was seen as a stable, resource-rich jurisdiction with a professional national oil company and a legal framework that protected foreign investment. That framework begins to erode in 2004. Chávez moves to renegotiate existing contracts, demanding that foreign partners accept minority stakes in their own projects, with PDVSA taking majority control. The renegotiations are framed as a restoration of national sovereignty, but they are also a unilateral change to agreements that were signed under different terms. The renegotiations are not optional. Companies that refuse face expropriation. In 2007, ExxonMobil and ConocoPhillips reject the new terms and are forced out of Venezuela. Their assets are nationalized, and both companies pursue international arbitration to recover compensation. The arbitration cases drag on for years, and the compensation awarded, when it finally comes, is far below the book value of the expropriated assets. Total, like other international oil companies, faces a choice: accept the new terms and remain in Venezuela, or refuse and risk expropriation. The company evaluates the decision through the lens of asset value, production volumes, and long-term strategic positioning. Venezuela holds the world's largest proven oil reserves, and the Orinoco Belt is one of the most resource-rich regions on the planet. Walking away would mean forfeiting access to decades of potential production. Total chooses to stay. In 2006, the company agrees to restructure Petrocedeño as a joint venture with PDVSA holding 60% and the foreign partners sharing the remaining 40%. Total's stake is reduced, but the company retains operational involvement and a share of production. The decision is framed as pragmatic. The reserves are too large to abandon, and the relationship with PDVSA, while difficult, is still manageable. But the operating environment continues to deteriorate. PDVSA, once considered one of the most competent national oil companies in the world, is hollowed out by political appointments, budget cuts, and the diversion of oil revenue to social programs. Technical staff are replaced with political loyalists. Maintenance is deferred. Investment in infrastructure declines. Between 2003 and 2013, thousands of experienced engineers, geologists, and technicians leave PDVSA, either through dismissals or voluntary departures. Many emigrate to other oil-producing countries or retire early. The brain drain leaves PDVSA without the institutional knowledge and technical capacity to manage complex operations like heavy oil extraction and upgrading. The company becomes increasingly dependent on its foreign partners to maintain production, but it lacks the capital to fund its share of joint venture expenses. The international oil companies operating in Venezuela begin to experience delays in payments, disputes over cost recovery, and a general breakdown in the operational partnership. PDVSA is no longer functioning as a commercial entity. It is functioning as an arm of the state, subject to political directives that override technical and financial logic. Total's management is aware of the risks. Internal assessments recognize that Venezuela's political trajectory is unstable, and that the company's assets are exposed to expropriation, contract breach, and operational paralysis. But the calculus remains. The reserves are vast, the sunk costs are significant, and exiting would crystallize a loss. The decision to remain is not made once. It is made continuously, year after year, as conditions worsen and the window to exit without major losses narrows. France's diplomatic relationship with Venezuela also plays a role. The French government, through its embassy in Caracas and its engagement with Chávez's administration, seeks to maintain commercial ties and protect French corporate interests. Total's presence in Venezuela is seen as strategically important, and the company receives political support from Paris in its negotiations with PDVSA. But that support cannot change the fundamental reality. Total's assets are in a jurisdiction where the government can unilaterally rewrite the rules, and where the rule of law does not protect foreign investors from political risk. The decision is not a single contract signature or board resolution. It is a pattern of choices made over more than a decade, each one justified by the scale of the reserves and the hope that the political situation will stabilize. Between 2006 and 2013, Total continues to operate in Venezuela despite mounting evidence that the partnership with PDVSA is unsustainable. The company participates in the restructured Petrocedeño joint venture, honors its capital commitments, and maintains technical staff in the country. The production volumes are significant, and the revenue, when it flows, contributes to Total's upstream portfolio. But the revenue does not always flow. PDVSA begins to accumulate payment arrears to its joint venture partners. The state oil company diverts cash to fund government programs, leaving insufficient capital to cover operational expenses and partner distributions. Total and other international oil companies are owed hundreds of millions of dollars, and the debts continue to grow. The situation worsens after Hugo Chávez dies in 2013 and Nicolás Maduro takes power. Maduro inherits an economy already in decline, with inflation rising, foreign exchange controls tightening, and oil production falling due to underinvestment. His government doubles down on the policies that created the crisis, imposing stricter currency controls, expanding expropriations, and using oil revenue to subsidize imports and maintain political support. For Total, the operating environment becomes untenable. PDVSA's payment arrears grow into the billions. The joint venture cannot access foreign currency to pay for imports of equipment and services. Maintenance schedules are disrupted. Production efficiency declines. The company is still nominally a partner in one of the world's largest oil projects, but it has lost effective control over its own assets. By 2015, the decision to remain in Venezuela is no longer about upside potential. It is about managing a slow-motion disaster and hoping to recover some value before the situation collapses entirely. Total's leadership continues to engage with PDVSA and the Venezuelan government, seeking to resolve payment disputes and restore operational stability. The company participates in arbitration proceedings, negotiates debt restructuring, and explores options to monetize its stake. But the leverage is entirely on the government's side. Venezuela holds the assets, controls the regulatory environment, and has demonstrated a willingness to ignore contracts when politically convenient. The global oil market provides some relief. Oil prices remain relatively high through much of the 2010s, and Venezuela's production, though declining, still generates revenue. Total's financial statements continue to book reserves and production from Venezuela, even as the operational reality becomes increasingly disconnected from the accounting treatment. But the reprieve is temporary. In 2014, oil prices begin to fall, and by 2016, they have dropped by more than 50% from their 2014 peak. Venezuela, which depends on oil revenue to fund government spending and service debt, enters a full economic collapse. Inflation becomes hyperinflation. Food and medicine shortages become widespread. The currency becomes worthless. PDVSA's production falls sharply as the company lacks the capital to maintain wells and infrastructure. For Total, the situation is no longer a matter of risk management. It is a stranded asset crisis. For a brief period in the mid-2000s, Total's decision to remain in Venezuela appears defensible. The company has accepted less favorable contract terms, but it retains access to one of the world's largest oil reserves. Production at Petrocedeño continues, and the upgraded synthetic crude is exported to international markets. The partnership with PDVSA is difficult, but it is still functional. Between 2006 and 2010, oil prices are high, and Venezuela's oil revenue is sufficient to sustain government spending and maintain some level of investment in the sector. PDVSA's operational capacity is declining, but the decline is gradual, and the joint venture structure allows international partners to provide technical expertise and operational support. Total's financial reporting during this period reflects the value of its Venezuelan assets. The company books reserves, production, and revenue from Petrocedeño, and the project contributes to Total's overall upstream performance. The political risks are acknowledged in risk disclosures, but they are treated as manageable. Inside Total, there is ongoing debate about whether to remain in Venezuela or to exit and redeploy capital to less risky jurisdictions. The company's portfolio includes assets in West Africa, the North Sea, the Middle East, and deepwater projects in Angola and Brazil. Venezuela is one piece of a diversified upstream strategy, and the decision to stay or leave is evaluated in the context of the entire portfolio. The argument for staying is straightforward. The reserves are enormous. The sunk costs are high, and exiting would mean writing off billions of dollars in investment. The argument for leaving is equally straightforward. The political risk is escalating, the operational environment is deteriorating, and the longer Total stays, the harder it will be to exit without catastrophic losses. The decision to stay wins, year after year. The reserves are too large to abandon, and the hope persists that the political situation will eventually stabilize, either through a change in government or a pragmatic shift in policy that allows the oil sector to recover. That hope does not materialize. Petrocedeño's production during this period averages around 180,000 barrels per day of synthetic crude, making it one of the larger heavy oil projects in the Orinoco Belt. The upgrading facility, built and operated by the joint venture partners, converts the extra heavy crude into a lighter product suitable for export. The technical execution is sound, and the facility operates at high utilization rates when it has access to inputs and maintenance. But the commercial and financial relationship with PDVSA becomes increasingly strained. The state oil company's share of joint venture costs is often not paid on time, forcing Total and its partners to advance capital to keep operations running. PDVSA owes the joint venture partners for their share of production, and the arrears accumulate over years. Total's receivables from PDVSA grow to more than $1 billion by the mid-2010s, and there is no realistic prospect of full repayment. The Venezuelan government's foreign exchange controls compound the problem. The joint venture needs to import equipment, chemicals, and spare parts, but accessing US dollars to pay for those imports requires government approval. The approval process is slow, arbitrary, and often denied. Projects are delayed, maintenance is deferred, the operational efficiency of the facility declines. By 2013, when Maduro takes power, the conditions that made Venezuela an attractive investment destination no longer exist. The government is authoritarian, the economy is collapsing, PDVSA is dysfunctional, and the risk of expropriation or operational paralysis is no longer hypothetical. It is the baseline operating assumption. But Total does not exit. The company continues to engage with PDVSA, continues to participate in the joint venture, and continues to report its Venezuelan assets as part of its upstream portfolio. The decision to remain is no longer driven by opportunity. It is driven by sunk costs, contractual obligations, and the absence of a clear exit path that does not crystallize massive losses. ExxonMobil and ConocoPhillips, which exited Venezuela in 2007, pursue international arbitration and eventually receive compensation awards in the billions of dollars. But the awards take more than a decade to secure, and collection remains uncertain. Venezuela refuses to honor the awards, and the companies must pursue enforcement actions in jurisdictions where Venezuela holds assets. The lesson for Total is clear. Exiting Venezuela is costly, time-consuming, and does not guarantee recovery of value, so the company stays. It stays through Chávez's final years. It stays through Maduro's early presidency. It stays as the economy collapses and oil production falls. It stays as PDVSA's arrears grow and the joint venture becomes insolvent in all but name. The consequences of Total's decision to remain in Venezuela unfold in stages, each more severe than the last, and each shaped by forces outside the company's control. In 2017, the Trump administration begins imposing sanctions on Venezuela in response to the Maduro government's authoritarian crackdowns and human rights abuses. The sanctions initially target individual officials and restrict Venezuela's access to U.S. financial markets, but they escalate quickly. In January 2019, the U.S. imposes comprehensive sanctions on PDVSA, prohibiting American companies from doing business with the state oil company and freezing its U.S.-based assets. The sanctions are designed to cut off the Maduro government's access to oil revenue, and they are enforced by the Office of Foreign Assets Control, or OFAC. Any company that continues to do business with PDVSA risks secondary sanctions, which could restrict access to U.S. financial institutions, prevent transactions in U.S. dollars, and expose executives to legal liability. The sanctions create immediate operational and legal consequences for international oil companies operating in Venezuela. Total's joint venture with PDVSA, already strained by payment arrears and operational dysfunction, becomes legally and commercially toxic. The company cannot conduct business with PDVSA without violating U.S. sanctions, and it cannot exit the joint venture without PDVSA's consent. Total is forced to suspend operations at Petrocedeño. The company stops receiving oil from the joint venture, stops making payments to PDVSA, and begins the process of winding down its presence in Venezuela. The decision is not voluntary. It is imposed by external sanctions and the collapse of the operating environment. But the assets remain. Total still holds a 30.32% stake in Petrocedeño, and the reserves are still there, buried under the Orinoco Belt. The problem is that the reserves are inaccessible. PDVSA cannot produce them at commercial scale. International partners cannot operate under sanctions, and the Venezuelan government, facing economic collapse and international isolation, cannot restore the conditions necessary for investment and production. Total's Venezuelan assets become stranded. The company continues to report them in its financial statements, but with significant impairments that reflect the reality that the assets may never produce cash flow again. In 2018, Total records a $1.7 billion impairment on its Venezuelan assets. In 2019, the company takes additional impairments as the situation worsens. The carrying value of the investment is written down by billions of dollars, and the write-downs continue as the situation in Venezuela deteriorates further. In 2020, Venezuela's oil production falls to its lowest level in decades, below 500,000 barrels per day, down from more than 3 million barrels per day in the late 1990s. PDVSA lacks the capital, expertise, and equipment to maintain production. Wells are shut in. Infrastructure decays. The workforce, once among the most skilled in Latin America, is decimated by emigration and political purges. More than 5 million Venezuelans leave the country between 2015 and 2020, fleeing hyperinflation, food shortages, and political repression. The exodus includes thousands of PDVSA workers, engineers, and technicians who emigrate to Colombia, Ecuador, Peru, the United States, and Europe. The loss of human capital makes it nearly impossible for PDVSA to restore production, even if sanctions are lifted and investment returns. For Total, the operational partnership is dead. The company has no access to its assets, no revenue from production, and no realistic prospect of recovering its investment. The only question is how to exit without incurring additional losses or legal liability. In 2021, Total makes the decision to formally withdraw from Venezuela. The company transfers its 30.32% stake in Petrocedeño to PDVSA for no compensation. The transfer is structured as a forced divestment under the terms of the joint venture agreement. But in practical terms, it is an abandonment. Total writes off the remaining value of its Venezuelan assets and exits the country entirely. The decision is announced in a brief corporate statement. The language is careful, noting that the decision was made in the context of the current situation in Venezuela, and that Total has concluded that the investment is no longer viable. The company does not quantify the total losses, but analysts estimate that Total's cumulative investment in Venezuela, including capital expenditures, unpaid receivables, and foregone production, exceeds $4 billion. The exit is not unique to Total. Equinor exits in 2019. Chevron, which has a waiver from U.S. sanctions, reduces its presence to minimal operations. Repsol of Spain writes down its Venezuelan assets and ceases active operations. Eni of Italy follows a similar path. The exodus reflects a collective recognition that the political and operational risks have become unmanageable, and that the assets, no matter how large, are worthless if they cannot be produced and monetized. The consequences extend beyond financial losses. Total's experience in Venezuela damages the company's reputation with investors and stakeholders who question why the company remained in the country for so long despite clear warning signs. The decision to stay through multiple waves of nationalization, expropriation, and operational breakdown raises questions about risk management, governance, and the prioritization of sunk costs over strategic discipline. Inside Total, the Venezuela experience becomes a case study in the limits of contractual and commercial relationships in jurisdictions where the rule of law is subordinate to political expediency. The company's internal assessments acknowledge that the decision to remain in Venezuela was driven by the scale of the reserves and the hope that the political situation would improve, but that those assumptions were not validated by events. The broader oil and gas industry treats Venezuela as a cautionary tale. The country's collapse illustrates the risks of operating in resource-rich but politically unstable jurisdictions, where governments can unilaterally change the terms of investment, expropriate assets, or render them worthless through policy decisions. The lesson is not that international oil companies should avoid all political risk, but that they must price it accurately and maintain the discipline to exit when the risk becomes unmanageable. For Total, the cost of that lesson is measured in billions of dollars and 2 decades of capital misallocation. The company exits Venezuela in 2021 with nothing to show for its investment, and with the knowledge that the decision to stay was not forced by external events. It was a choice made repeatedly, year after year, based on the assumption that the reserves were too large to abandon. That assumption in the end was wrong. The reserves are still there, under the Orinoco Belt, as large as they were in 1996. Totalenergies no longer has access to them. PDVSA cannot produce them at commercial scale. The infrastructure that was built to extract and upgrade the heavy oil is decaying. The joint venture that once produced hundreds of thousands of barrels per day is dormant. In 2021, Totalenergies CEO Patrick Pouyanné stated publicly that returning to Venezuela was not on the agenda. The language is final, and it reflects a recognition that the company's two-decade investment in the country is over. The decision to enter Venezuela was made in the 1990s, when the country was open to foreign investment and the reserves were undeniable. The decision to stay was made continuously, through nationalization, contract renegotiation, payment defaults, and economic collapse. Each time justified by the scale of the opportunity and the cost of walking away. The decision to exit was made in 2021 when the cost of staying exceeded the cost of leaving and when the sanctions, the operational paralysis, and the political dysfunction made it impossible to continue. The financial statements record the losses. The annual reports describe the impairments. The corporate communications emphasize the company's focus on other markets and the decision to reallocate capital to less risky jurisdictions. But the reserves remain untouched, undeveloped, and inaccessible. And the record of the decision remains as well. A case study in how the world's largest proven oil reserves became a stranded asset, and how one of the world's largest energy companies spent 2 decades betting on a government that could not deliver.